And continuing to flag the risk in US equities, we just talked about a stress test yesterday, and today is playing out. Pre-market index futures are flashing red across the board again. And meanwhile, on a risk as a seesaw, the 10-year Treasury yield and the US dollar index are both reaping higher. Looking at the headlines, there's no obvious bad news, and Iran isn't making any moves. The scapegoat the market is planning this on is Bank of America's aggressive call yesterday for 3 rate hikes this year. Their thesis: the Fed's inflation problem has clearly deteriorated. They also project this week's core PCE to spike to 3.5% and nearly 70 basis points higher than last year. Now, personally, I don't buy into this 3 rate hikes ghost story. If that script actually plays out, the US is looking at a brutal triple kill across stocks, bonds, and currency. In reality, what goes up might come down. These headlines are just catalysts used to trigger the move. And one of the real triggers for this drop is the quarter end portfolio rebalancing I mentioned yesterday, with institutions set to dump nearly 165 billion in equities. And specifically, Japan's GPIF is expected to dump around 60 billion, US fixed income pension funds around 55 billion, and the Norwegian sovereign wealth fund another 40 billion. And while this capital only accounts for about 0.25% of the 65 trillion US equity market, the real danger is that leverage is currently sky high. And once these passive selling algorithms kick in, volatility gets amplified, easily triggering a stampede. So to dodge the upcoming volatility and Micron's earning risk, it's completely normal that some smart money is choosing to front run the move and cash out early. So looking at the current tape, if you've got long-term conviction, don't panic. On one hand, you can trust Trump because he always finds a way to bail US stocks. On the other hand, this is essentially a technical, mechanical portfolio rebalancing. It doesn't mean that the AI fundamentals are broken. Historically, corporate buybacks, balanced funding flows, and long-term deep buyers usually absorb this rebalancing pressure pretty quickly. Now, let's talk gold. The overall tape is looking incredibly weak right now. I gave you guys some mental therapy yesterday because I wanted you to keep the faith and not get discouraged, even if we end up heading down to that 3,000 level range I've been warning you about. So let me break down what is actually happening to gold in the short term. At its core, it's a liquidity issue. There's only so much cash in the system, and the world's top AI tech giants are aggressively issuing debt, draining hundreds of billion in liquidity. For instance, Nvidia and Google recently issued tens of billions in corporate bonds, and these bonds offer stable yields with virtually zero risk. In contrast, holding gold pays zero yield and forces you to watch wild daily swings and might even lose your money. So naturally, capital is voting with its feet. So this transmission loop of AI cash burn plus rising interest rates is continuously crushing gold. And to make matters worse, AI-driven quant models are self-reinforcing, amplifying gold's downside. Today's mainstream quant algorithms are constantly scanning dozens of variables like rates, the dollar, and capital flows. The moment the algorithm flag AI sector booming and real yield rising, they systematically dump gold and load up on tech, creating a massive coordinated sell-off. And even worse, once these highly crowded strategies spot a downtrend, they automatically scale up their shorts and causing gold to plunge far beyond what it actually fundamentally justify. But remember, no matter how hot AI gets, it will eventually pull back. And once the profit-making momentum in the AI sector fades, or when valuations get too high for people to chase and high-flying capital rotating out, will need a safe haven to park. When that day comes, they will inevitably turn right back and look at gold. And that is one of my core macro thesis for remaining long-term bullish on gold. Based on the current tape, here's my trading strategy. Play this week as a range-bound market. We have initial support stack around 4,050 and with overhead resistance near 4,220. And within this range, focus on selling high and buying low. Keep it quick and absolutely do not chase the breakout. As always, this is just my personal analysis, not financial advice. And also shout out to EBC Financial Group for sponsoring the content. Bye-bye.